to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On November 3rd, we as a nation will elect a president. And although there are some third-party candidates out there, it's really going to boil down to a choice between the incumbent, Donald Trump, and his primary opponent, Joe Biden. And as a real estate investor, whether you are currently an owner of real estate assets or you plan to get started, you need to know what these candidates bring to the table when it comes to their tax policies. And one of the tax policies that directly affects us as investors is the capital gains tax. Now, there are other taxes out there, but this is the one that normally comes to mind. So let me explain to you how it works. When you sell an investment property, you're required to pay tax on the gain. If the property appreciated in value during your ownership period, which is pretty likely that it happened, or if you took depreciation deductions for tax purposes, which the IRS wants you to do, most states and the IRS view the gain as taxable. However, there's a thing out there called a 1031 tax deferred exchange. You may have also heard it called the Starker exchange. That's how I learned about it. And what that does for you as a real estate investor is it allows you to defer your capital gains tax. It also takes a stab at any recapture of depreciation that you've taken. So what that means is when you sell your business or investment real estate and replace it with a different business or investment real estate asset, and you use that 1031 exchange, you legally can defer payments of the capital gains tax normally required on the sales. Yeah, it's true. It gives you greater purchasing power by allowing you to use funds that you would have paid in tax towards the new investment. And without using a 1031 exchange, you would be required to pay capital gains tax on the gain and thereby significantly reducing the amount you have to reinvest. Now, that 1031 exchange, it is not a tax loophole. It's been around for well over 90 years. It's written right into IRS code, which, by the way, was approved by Congress, and it allows anyone who meets the requirements to sell their property and defer paying taxes on the gains. And what I've done today is I've asked Dan McCabe of ERG, also known as Exchange Resources Group. They're a Lifestyles Unlimited vendor, to come on the show to discuss the direction we might head in when the election results are concluded. Now, keep in mind, right now, we've got a current tax policy in place, which, if the current president does not get reelected, we may have somebody else calling the shots. So, Dan, fill us in. What are you seeing in your space with regards to what a change in the White House might create for the 1031 exchange?
Well, what I've done, Al, is go back and not listen to the little square box called the TV, but in fact read candidate Biden's tax plan. And there are a couple of major things within his tax plan that gravely concern me for personally and as a real estate investor. Let me just walk through a couple of those. Number one, there's a substantial increase in the tax rate. The tax rate from in the 20 ballparks to, well, let me just tell you exactly, from from a max for an individual of 37% to a max of 39.6%. And most people won't be concerned about that because I say it doesn't include me. But there, as always, the devil is in the details. There's a kicker there. The corporate rate will go from 21% to 28%, which will mean a substantial decrease in the valuation of corporations and thusly the dividends that they pay. But let's go back to that individual rate because most people won't think that will affect them. The big difference that I see is, agreed, that's only a 2.6% increase, but that increase creeps down and it's been felt in all of the tax categories. So every range of payer is going to get bumped up. But more importantly, what the Biden plan appears to do is to put a much larger bucket of income that is going to be taxed at that rate. Quick example, the elimination of Section 1031. At this point in time, if you were to sell a property, you would be confronted with a couple of taxes. Obviously, you've got depreciation recapture, which at this date and time is 25%. You've got a capital gains tax, and I'm speaking on the federal side now, which ranges from 15 to 20%. Number of states, Texas not being one, and I realize that's where you're located, but there are only 5 states in the union that do not have a state income tax. So most states you're going to get hit with a state income tax, and that varies from about, well, here in Colorado it's 4.63, in California it's 13.3. So it ranges between those across the nation. And you get hit with the net investment tax, also known as the Medicare surcharge or the Obamacare surcharge, of another 3.8%. So all of these are small taxes that you get hit with, and they're all at, from 25% on down. The net effect, it appears, as best I can read it, and let me just point out that I've been reading these for a long, long time, is that they're going to substantially increase the adjusted gross income. So everything is going to go into adjusted gross income, and then those higher rates are going to be applied to that adjusted gross income. So, instead of looking at a 25% depreciation recapture, that depreciation recapture will now go into the adjusted gross income, and you'll be looking at a, 35 to 39% increase.
Hold that thought, Dan. We're getting ready to go to break. When we come back, I'm going to get back inside your mind because I'm very interested.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. On today's show, I have a very special guest. It's Dan McCabe with ERG. Now, ERG stands for Exchange Resource Group, and they are a Lifestyles Unlimited vendor, meaning they're one of the people that you can put on your team as a real estate investor to help you get moving forward as fast as you possibly can, safely, of course, towards getting yourself retired in 5 years or less. And one of the things that Dan is talking about that you really need to sit back and listen to is he is talking about the proposed tax plans that one of the candidates, Joe Biden, is proposing should he become elected president. And by the way, that presidential election is like 48 days away. So I think you really need to sit back and you need to listen to Dan's advice because he has dug through Biden's policy. I mean, he has read it word for word. He's gone back and reread it. I mean, and I can't imagine how boring that is. But he is here to help us understand what is in that policy and how it affects us as real estate investors. Dan, you want to pick it up from the last segment? I mean, you were talking about all kinds of things with regards to ordinary tax rates and things like that. What do we really need to understand?
I think what you really need to understand is that the Biden plan hits you in 2 locations. Number one, he is proposing the elimination of capital gains, and he's proposing thusly the elimination of Section 1031, which allows for the deferral of the capital gain and the other taxes that are involved. So that's the first thing. He wants to eliminate that and force you to pay tax on each transaction as it's done. Then he is substantially increasing the rate and the amount of taxation. The example I use real quickly is right now the max current rate for capital gains tax is 20% on the federal side. Under his proposed tax rate, that would jump to 39.6. So it's almost a doubling of the current rate. That would substantially reduce the desirability of ever selling a piece of trade, business, or investment property, because the taxes would have a substantial reduction on the profitability thereof. So that's the first thing. The second thing is that he is proposing the elimination of basis, and that's been a basic estate planning tool for the 47 years I've been practicing law, and it was for a considerable period of time before that. And essentially what that means is that when you inherit a piece of property, you, as the inheritor, get a step up in basis, so that the basis of the property becomes the fair market value of the property at the date of death of the devotee or your parents. In this case, we'll use that example. So if your parents purchased a house for $10,000 back in 1950 or $30,000 back in 1950, and today it's worth $250, which is not unrealistic, you would get it at that step-up figure, so that when you sell it 10, 15 years down the road, or you exchange it, your taxes would be based on that $250,000 base. The Biden plan says, no, you go clear back and you get taxed on the profit that your parents gained during their lifetime. So not just the profit that you gained, but the profit that your parents gained during their lifetime. So it substantially modifies a bedrock tax planning matter for most Americans.
Wow. I'm kind of sitting back in my chair. I feel like Mike Tyson has just punched me in the nose, and I'm trying to process all of this stuff, because what's going through my mind is the concept that taxation is going to put a very negative spin on my ability to grow wealth over time. And that's one of the things that I'm working on. I am working on exchanging. Well, you guys are helping me out with the exchange of a couple of my properties. And, one of the most significant benefits to me is the fact that even though I've owned these properties for 18 years and I've depreciated them down, and there's the potential for that recapture tax, and of course the value has gone up over time, so there's that potential for the capital gains tax. If I didn't have access to a 1031 exchange, based on the numbers that I ran, about 70% of the gain that I would pull off this property would have to be pushed aside and given to the government, and that would severely impact my ability to purchase the follow-on property. Am I tracking?
You are tracking really well, and I guess my next question would be, how long do you want to play a game where 70% of your efforts you don't get to enjoy? It has a substantial effect on you. Now, let's just take this out one more level, Al. Let's just take this out to the properties that you own. I'm assuming you've been renting them out for a period of time. The property you're going to buy, I'm assuming you're going to put that back into the rental pool. And I guess one of the unintended consequences of this is the effect it's going to have on affordable housing, the effect it's going to have on the workforce housing that's available to rent. Because if you can't, if you're going to have to pay that much tax every time you do a deal, how long are you going to want to continue to play that game? How long are you going to want to put your efforts and your resources towards that game where you're giving away such a huge percent of whatever the gain, the profit is? And that's why I think we're we've got to look beyond just what's here, and we have to really look at the unintended consequences. Because you and I are the type of, and the people listening to us today are the folks who live with this on a day in, day out basis. It's not the people sitting in Washington, D.C. who's going to vote on this and whose retirement is guaranteed by the federal government. We don't have that benefit. We have to go out and make our own, or we choose to go out and make our own, which is you and my situation. So how long do you want to continue to play the game? And speaking of unintended consequences, one of the other things I would point out is Bloomberg News a week ago said that the federal government now owns 30% of the U.S. mortgages. That's up from the 21% they owned before COVID. So they've stepped it up 9% in just the last 6 months. And at their current pace, at the end of the year, the federal government will be responsible for 34% of the U.S. mortgages. If the real estate values, which we're going to get into some numbers here in a moment, take a huge dip, their left hand is holding a third of the mortgages in the United States, and their right hand is forcing the value of those assets downward. Well, who's going to get caught in the middle of this? You and I, the taxpayer.
Yeah, we're going to get squarely in the middle of it, and I think what they failed to realize is that if you have money working in the economy, that money will be taxed along the way, and if you can minimize the taxes, that allows more money to flow. Hey, we're getting ready to go to break. When we come back, we're going to get into those values right after this.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. If you're just joining us, we're into a pretty in-depth conversation with regards to taxation. And what we're talking about is what would potentially happen to taxation. And we're trying to keep it narrow. We're trying to keep it on real estate. If Joe Biden is elected president. Now, Joe Biden has published his proposed policies on what he wants to do if he becomes president. And I will tell you, it is significantly different than what Donald Trump is currently doing. So you're going to be a voter, and you need to understand what these policies could do to you as either a full-blown real estate investor or somebody who is aspiring to be a real estate investor. Because, what Dan's telling me is it's kind of scary, to be honest with you. Now, let me also tell you, Dan has testified before Congress on these types of matters. So he is probably the best qualified person that I could find on the planet to discuss this information with you. Dan, we talked about Biden's policies in the last segment. What would happen if Trump got reelected? I mean, what do you see on the horizon?
Well, at this point, I don't see a whole lot of modification. As you'll recall, shortly after he was elected, Trump made some tax modification proposals, managed to get those through, and so we're now living with that. And he has not proposed, that I have seen, major changes beyond those that he got. He's done some tweaking and wants to do a little bit more, I think, with withholding taxes to allow businesses to retain that for a period of time so that they can, better weather this coronavirus storm. He hasn't proposed any major changes as of this day, and certainly nothing that we see.
I think we had you breaking up just a little bit there, Dan. So we missed the last sentence. If you would like to repeat it.
Well, I don't see any major changes from the Trump camp that are anywhere close to these horrific changes and huge changes that are being proposed by Biden.
So really the concern is if we have a change in the presidency, that president will obviously propose his policies, and he'll try and push those through Congress and try and get those things written into law, and those things could ultimately have a very detrimental effect on what we're trying to accomplish as real estate investors.
Yes, let me point out one thing that, as you know, there's different factions of the party, and Biden's getting a lot of pressure from the far left. The young lady commonly known as AOC has proposed, it is not in Biden's plan, but she has proposed, her side of the party is pushing, that capital gains be taxed on an annual basis, so that rather than having a tax ramification on the date you would sell something, that you would be forced to revalue the property each and every year and pay quote-unquote capital gains on your quote-unquote supposed gain during that year. So this written proposal from the Biden camp is not the far left version. It's if you can have a centrist version in the far left camp, this is the centrist version.
Well, that scared me too. I mean, I'm just imagining having to get an appraisal every year on all of my properties just so that I can report a gain on the property so that I have the benefit of paying taxes on a gain that I haven't even realized. Well,
that, and if you can imagine trying to go back and calculate the gain that you made from your grandfather's property that he left to you that he bought 50 years ago. I mean, I don't think the people have thought of what the ramifications of their proposals will be.
Yeah, because, I mean, our game plan that we're working on is we're liquidating properties because they're not producing as well as other properties that we have our eye on are producing. And we're using that 1031 exchange concept to defer all of our taxes. And eventually, my wife and I are going to get to a point in time where it's time for us to check out from this planet. And our intention is to give all of those assets to our two children. I mean, that's our legacy plan. And holy smokes, that would crush the plan, because if they had to be responsible for the taxes that we deferred when they took over that property, they would ultimately probably just have to sell that property in order to pay the taxes, and there'd be nothing left for them.
That's true. And the next step of that is that year that they sell, their income is going to shoot up significantly. And so they're probably going to be in that 39% bracket, even though they may not be in that bracket from their normal earned income. But since you can't defer the capital gains, that's going to shoot everybody up. And all of a sudden, your children are going to be in the top 1%, and they're going to be paying the max tax. So it's a kind of a dual threat situation that we all need to be aware of and to consider.
I mean, when you're reading through all of this stuff that Biden put out, did he make any reference to why he wants to mess around with something that has been working so well for the past 90, almost 100 years?
Wait a minute, Al. That would require applying some logic.
I'm sorry.
And I'm talking politicians in general, not just candidate Biden.
Right.
But no, these are just here's what I want to do. They don't give you reason and rationale. And interestingly enough, when you go to testify before those committees and subcommittees, you're not allowed to ask questions. You have to submit your testimony in writing in advance. I think it was 27 copies we had to give them, and then you're not allowed to ask those kind of questions. Why are you trying to do this? So there's just what I really want to point out to people is that we have to look at the unintended consequences of this. In 2016, the last time the Federation of Exchange Accommodators, which is our nationwide association I used to be president of, looked at this, we pulled up a bunch of numbers, which I think you'll find interesting. In 2016, the Tax Foundation is a pretty middle-of-the-road, or at least as middle-of-the-road as I can find, analysis entity estimated that the economy would contract, and I'm quoting here, a negative $18 billion if Section 1031 lifetime exchanges are repealed. Now, people will say, well, that's not true, and we've seen other ones that pay $15 billion. But, when you're in those numbers, what's a billion? A billion here, a billion there, pretty soon you're talking about some serious money, I think Lyndon Johnson said. But more importantly, what people need to understand is that 88% of the replacement properties in these transactions ultimately are sold in a taxable sale. So this isn't something that is never taxed. At some point in time, the government gets their tax, and they get more because the values have increased. This is simply a deferral to allow you to grow that individual retirement plan and grow that individual wealth. So those are big issues.
Yeah, those are definitely some big issues, and reasons why the listener needs to really sit down and understand who they choose to vote for, because it will have an impact on all of us. We come back from the break. We're going to talk more about 1031 exchanges right after this.
As I sit here and read article after article and see TV show after TV show, the normal person out there on the street cannot overcome their fear to get to the analytical part of this whole process. I'm not afraid of, and I'm actually ready for a recession, a crash of value of anything and everything. Why? It is the opportunity to do incredible stuff. But that's my analytical brain.
The United States has a very strong economy. We will return to our basic economic foundation. This is not going to be the end of the world for everyone. But you do need to take some action. And some actions will be more productive than others. And one of the things that I think you can do now is take this time, like you said, Del, people are going to be sitting at home, and you have a time right now to change your life. Make what you have work for you.
You need to get into lifestyles right now.
Join us for our free online workshop. Register at lifestylesunlimitedworkshop.com.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. On today's show, I have Dan McCabe with Exchange Resource Group, and they are a Lifestyles Unlimited vendor. They've been a vendor for a very long time, and what they do is they assist our members with exchanging property and following the 1031 exchange rules, which allows us to sell an asset and defer any taxes that would be due for capital gains or depreciation recapture, and move those tax liabilities onto a follow-on property. And the biggest thing that is beneficial for doing that is that you're not writing a big check to the government. You're able to use all of your gains to acquire an additional property. And what we're talking about is the fact that Dan sat down and he went through all of the documentation regarding candidate Biden's proposed tax plan. And he's got some things in that tax plan which would have a negative effect on us as real estate investors. Dan, you want to pick it up and give us more of those stats that you were reading?
You bet. And I'm quoting here from the Tax Foundation, who's a very authoritarian and very middle of the road, I guess, neither right nor left leaning. And they took the proposed plan of Biden, anticipated a 2021 to a 2021 to 2030 year, and here's their projections. They project that gross domestic product, GDP, of the United States will fall 3.51%. Capital stock, which would essentially be the value of assets in the United States, would fall by 3.23%. The wage rate would decline by 0.98%, and that we would lose approximately 585,000 full-time job equivalents based on that tax plan. And so it's hard for people like to really reach out, project what it might do, but this is what the Tax Foundation does. And those are some pretty, from my point of view, those are some pretty scary numbers, that we're going to lose 3.25% of the value of the assets of the United States. So, that the average worker is going to take a 1% wage reduction, and that 585,000 people are going to have their jobs eliminated. And from the real estate aspect, that includes not just realtors and not just lenders and not just qualified intermediaries, but that involves the construction trade, all of those types of ancillary, the Home Depot people and all of those types of ancillary things that are affected by a major shift in the tax proposal. And, somebody once said, if you want to modify behavior, just change the way you treat people's money. And so I've always told people, have always looked at me a little bit when I say this in my presentations, but I've always said, obviously the primary purpose of the federal income tax is to raise revenue. But the secondary purpose is to affect social change, affect how you and I act. We will act differently based on the risks and rewards that are presented to us.
Yeah, I'm looking at those numbers, and I don't like the fact that unemployment goes up, that stock values go down, that people lose income because the wages go down, and all to support what? Higher taxes, which go to pay for what? I mean, why do we need that change in our current situation?
Well, I can tell you my thoughts on the subject are that it's to finance the basic transfer of wealth from producers to absorbers, to transfer funds in the form of government programs from those who produce value to those who absorb that. And essentially, it's buying a constituency. You're buying votes, and that's what. Then you have to fund that in some fashion, and since the government doesn't produce wealth, only private individuals produce wealth. You have to take it from those private individuals who produce wealth. I know that's basic, but that's the only way I can interpret.
Yeah, and I think the challenge there is when you stifle people like us as real estate investors, and you take away the benefits that we would receive by just using the 1031 exchange. You're going to put me in a situation where I'm not interested in liquidating that property. I'm not interested in selling a property. I'm not interested in going and finding another property that I can fix up to like new condition and provide the best product at the best price for the best people in the marketplace. I mean, that is problematic.
In my humble opinion, it's very problematic from both ends of the scale, not just from the investor end. But let's just assume for the sake of argument that I'm the renter looking for a place to live. And all of a sudden, it isn't worth your time to go buy that other rental house. Then I don't have a place to live. And it's, they claim that they're doing this to help those on the bottom end of the scale. And I think if you seriously look at the, potentially unintended consequences, maybe they are intended consequences, it's going to substantially reduce the affordable workforce housing living accommodations in the United States, because new dollars are not going to be going into that, and old dollars are going to be exiting that. So both ends of the spectrum, it's no longer going to be as advantageous for you and I and other individuals across the nation, hopefully most of the people listening to you, to continue to play that game. We'll just sit on the sidelines, hang on to our money, and not do anything. And so we are restricting the pain to ourselves, but what none of us realize is we're also inflicting, to some degree, burdens on other people because those properties are no longer available.
Yeah, and I'm kind of seeing, from you made a good point, take a look at it from the renter's perspective. When my expenses go up to operate a property, whether it's because I'm paying additional taxes or anything like that, that money's got to come from somewhere. And the biggest concern I have is that I would have to push rents higher, not for a profit standpoint, but just to try and break even with what the government is going to do to us.
Well, and don't forget, we're just talking about the federal government. If you're an income property owner, I anticipate that you can see similar types of moves from the various states and from the various localities. And as you know, a number of states really hang their income hat on real estate taxes. And so that's the immediate place where I anticipate we're going to see a change. And as you know all too well, and I do too, as income property owners, we've been hit with this moratorium that you can't do any eviction. So our expenses don't get affected, but our income can get severely affected. And we the taxpayers are the ones caught in the middle, not those who are making the rules, maybe at the federal or state level, and not those who are enforcing the rules at the state or local level, but we, the taxpayers, are the ones caught in the middle. It's easy for the governor to come out and say, you can't use the courts to evict anyone. But he didn't bother to say, oh, by the way, we're not going to collect any taxes for the period of time you couldn't collect it from your renters. So, again, we, the people, are stuck in the middle and paying and experiencing the pain and paying the price.
Yeah, I think what it boils down to is we all have to make very good decisions on November 3rd and make sure we select the candidate that is going to support what we do for investments and, to be honest with you, the growth of our economy and our nation. Hey, we're getting close to the end of the show. Can you give us about 60 seconds on what ERG does for an investor?
Certainly. We act as what is called a qualified intermediary. We're required by the Internal Revenue Service if you're going to do a 1031 tax-deferred exchange. So we prepare the documentation, and we hold the money, and we forward the funds. For you as an investor, what we really do is raise your confidence level to the point you're very comfortable going forward with your project. You know the real estate. You know the past real estate. You know the future real estate. We're going to come alongside you and provide that support, information, documentation that you need to make sure that your transaction takes place as it should. That's essentially what we do.
And how do we get a hold of you?
You can contact us. Our direct number is 303-789-1031. Now, isn't that original?
That was pretty easy.
303-789-1031. That's going to get you to our main office here in Denver. Obviously, we have our office in Texas, and you can contact them there. There's the Dallas office. There's a Tampa, Florida office, and there's a Louisville, Colorado office. But that 789-1031 number will get you to our main office. We'll get you the information and the assistance that you need.
Well, thanks, Dan. I appreciate your time on the show. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.